How many times it happened with you that market was bullish and you bought a call option or you bought a future thinking that you will go long, and you bought a call option, market started going up, came down, took your stop loss and again started going up. You bought a future, you kept your stop loss, it came, took your stop loss and started going up, making you frustrated because your direction was right, still your stop loss hit. You took another trade, there also it came down, took your stop loss and again started going up. Two back-to-back stop loss hit. Your direction was right, but still your stop loss hit, making you more frustrated. Sounds familiar, right? If you are wondering if there is any strategy where you don't have to keep your stop loss and you can take a directional based trades, having a good sleep without keeping stop loss, is there any strategy? Yes, that is what I'm going to discuss in this video about no stop loss trading strategy. If you have been following me from long time on YouTube videos, you know that I am a big advocate of stop loss. I say that always trade with stop loss. Stop loss is part of doing business. Stop loss is like cost of doing the business. But you are wondering why today in this video I am saying that you can take the trade without keeping stop loss. The reason why I am sharing this strategy, because this is going to be one of the strategies out of the 14 strategies which I am going to discuss in my new options course called Option Strategies Made Easy. Yes, I am launching a new course called Option Strategies Made Easy for both option buyers and option sellers, which I will be launching in a day or two, where you can see the details below this video in the description section. There I am going to discuss 14 simple option strategies, and today's strategy, one of those option strategies. Okay guys, so let us start with this strategy called no stop loss strategy. So let us see what is this strategy is all about. Suppose Nifty is trading at 16,350 and you are bullish on the market. Your view is bullish. Okay, you're thinking that market will go up, Nifty will go up. So what you can do? What all the options are there when you want to trade in stock market for going long? First is you can buy in the cash. But you should know that you can buy in the cash only in stocks. In Nifty and Bank Nifty, you can't trade in the cash, right? So it is ruled out. So what is the next one? Next one is you can buy in the future. Yes, you can buy Nifty future. But the disadvantage here, if you want to buy future, you need to have bigger margin in your account. Another thing is that suppose future is trading at 16,400. Okay, you bought a Nifty future. As I said earlier, you went long here, you kept your stop loss here. Nifty started coming down, took your stop loss and started going up. This can happen, right? And then when it start going up, you'll go and buy here again, thinking that now you will go long. Again, it comes, take your stop loss. So stop loss is very common when you are taking directional based trades, right? So that is the problem with the futures. Another problem is, even though you have a stop loss, there can be a gap up and gap down, and your stop loss may not get triggered. So these are the disadvantage with futures. Let us see what is the next option. Next option is very popular with retail traders, that is the buying calls, right? This is one of the very common with retail traders, new traders. So they think that buying call is the most simple and more lucrative because they know that unlimited profits in buying call option, naked call option. Let us see what are the disadvantages. Main disadvantage with the call option is that probability of profit is lesser. Then you have to pay high premium. Then there is something called Vega and Theta. If you don't know, then you should know this. If you are trading an option, you should know that there is something called Theta and Vega option Greeks. Vega is the volatility, Theta means time decay. If you bought your option when volatility high, even though it's going in your direction, there is a chances that your option price will come down because you bought at high volatility. Theta means time decay. If there is no much left time for the expiry and you bought the option, even though it's going slowly in your direction, still you can lose money here because of the you bought out of the money option and it is start decaying, its and value is decaying. So that is why buying calls, there are disadvantage, and the main disadvantage which I discussed earlier, you buy a call option and you keep your stop loss. There is very common that stop loss gets triggered and again it starts going. Your direction is right, but still your stop loss hit. It sounds familiar to most of you because it's very common in trading. Put selling. If you are bullish, you can sell the put option also. Here also, just like future, you need a big trading capital, you need margin money, And also here also same problem. If you don't keep a stop loss, losses can be unlimited. Is there any options? Is there any other method where you can take a bullish view, you can go long in the market, but you don't have to worry about huge margin money. You don't have to worry about your stop loss keep getting hit. You don't have to worry about unlimited losses. You can have a peaceful night without worrying about your stop loss, without worrying about gap up, gap down. Yes, there is a strategy in options called bull call spread. So this is one of the option strategies where you can take a long view on the market if you are bullish on the market, and you don't have to worry about big margin money. You don't have to worry about stop loss keep getting hit. You don't have to worry about unlimited losses. All these are the advantage of going for bull call spread. What is bull call spread? Bull mean you have a bullish view. Call mean you will be having a calls as an instrument in that. You will be using calls. Spread mean whenever you buy a strike price and sell another strike, that is called spread. Mean you are buying and selling both. That means you buy a call and you sell a call. That is called spread. Here you will only buy the calls. In spread, you will buy and sell both of same instrument of same expiry. Suppose Nifty is trading at 16,350. So you can go and buy 16,400 call option and you can sell 16,700. Anything you can buy 16,350, 16,400, any call option. So that means wherever you are trading, you are taking one at the money or slightly out of the money option. You will buy a call and you will sell a call. Both you will buy and sell both. You will buy slightly OTM or at the money option, preferably at the money option. This is called spread, bull call spread. So what are the advantages? What are the benefits it has that we'll see in the coming slide. Let us look at this slide. You can see that 10th March expiry, Nifty is currently trading at 16,380. Buying a call option of 10th March, strike price is 16,350, call option currently trading at 265.75. So that means if you want to buy a call option, pure buy a call option, then you have to pay this much premium. You have to pay a premium of 13,288. But what is the maximum profit loss you can expect here? Maximum profit is unlimited, just like lottery ticket, right? Small investment and you can earn big money. Call option also like that. Maximum profit unlimited. Maximum loss you can incur is, this is the maximum loss you can expect in call option is the premium whatever you pay. Now what about the margin funds required? You need only this much funds. 13,000 if you have in your account, you can go and buy a call option 1 lot. Now let us see the next one. Next one is you are selling the put. You are an option seller, not a buyer. So in that case, you sold one put option 16,351 lot, and this is the premium, current premium 239. It was trading at 239. And how much premium you will collect? 11,980. Because you are an option seller. So that is the maximum you will, that is the premium you will collect. Like an insurance company, how they collect the premium from you. Here also option seller will collect premium from. For him, what is the maximum profit he gets? Maximum profit is the only premium he gets. But what is the maximum loss? This is the maximum loss, provided you don't have stop loss. Maximum loss can be unlimited in option selling if you don't have stop loss. But probability of profit is good, which is 66%. But look at the funds. 1 lakh rupees you have to be have in your account to buy 1 lot. If you want to buy 10 lots, you need 10 lakh rupees. So that means you need to have a high funds here. But probability of profit is good. What was the probability of profit in option buying? Look at this. Only 36% is the probability of profit. POP means probability of profit. Here, probability of profit is higher, but you need higher margin. More than 1 lakh rupees you need for only one. Now we'll see that bull call spread, which we discussed about the bull call spread. In bull call spread, what I said, you will buy one at the money or slightly out of the money strike price. So here you bought one call option at 16,400 by paying the premium of 232, and you sold one call option at 16,700. You bought one call option and you sold one higher strike option. Obvious that when you sell higher strike, premium will be less. Here premium is more, here it is less, right? So overall, how much you will pay? Total, how much you will pay? You will pay around 133. You paid 232, right? Because you bought option here. You collected the premium also, right? Both you are done at the same time. So 232 minus 99.3, how much it comes to? It comes to around 130, right? Around 130. So how much premium you will pay? 6,650, right? Here you will pay only premium 6,650. What was that in call option? Call option, you were supposed to pay 13,280 and you had to pay premium of 265.75. Here you have to pay only premium of 6650 and you will pay only 133 because 232 minus 99. And you can see that here probability of profit better than buying a call option. Margin money funds required 28,000, not much, not like selling puts, not like future and all this. You need only 28,170 in your account to do a bull call spread. But look at this, maximum profit 8350, maximum loss 665. So it's almost like close to 1.5 risk reward, right? So maximum loss you will incur at the time of expiry is this much. Maximum profit you can earn is this much. So that is the bull call spread. Now let us go to Excel sheet. Let me make you understand more about this bull call spread. So total premium you paid how much in the plain call option? 265. What is the maximum risk you will incur in buying a plain call option? If Nifty doesn't go up, you are bullish. If Nifty start going down, your loss is this much. This is the maximum loss in buying a call, right? Because you paid the premium of 265. So what is the maximum loss per lot you can expect per month? Maximum loss at expiry 13,250 because you have paid the premium of 265. Now let us look at the bull call spread. Bull call spread, you bought a call option at 232.3 and you sold a call option at 99.3. Total premium, how much you paid? 133, right? That's what we have seen in the previous slide. So your maximum loss will be only 1. In the bull call spread, your maximum loss is this much. By having a naked call option, your loss will be this much. So overall, you will have this is the maximum loss. But one thing you have to see that here, profit also limited. How loss is limited? Profit also limited in bull call spread. Here, profit can be unlimited, right? Profit as Nifty is going up, your profit can be unlimited. But here, profit will be limited in bull call spread. But why it is useful? When you are mildly bullish, then you can go for a bull call spread. Suppose your target is only to take 250, 300 points in Nifty. You are not looking for 1,000 points and all this. If you are only slightly bullish, then why you have to go for paying high premium? You can go for paying lesser premium and you can go for bull call spread. When buying a naked call can work when you are expecting huge move, like 1,000 kind points of move in Nifty. You are very bullish, you are super bullish, then you can go for a naked call. But if you are slightly bullish, only you think that Nifty will go to around 300, 400 points, then you can go for bull call spread. Your profit is capped here in bull call spread. Why? Because you sold the higher strike. Wherever the strike you sold, that is the maximum cap. After that, your profit is limited. Maximum loss at expiry this much, here maximum loss at the expiry this much. If you are bullish on the market, what you can do? You can buy in the cash, but it's ruled out because you can't trade in Nifty and Bank Nifty in the cash. So first thing is ruled out. Futures, if you want to buy in futures, disadvantage is high margin required. Risk of frequent stop loss and gap up, gap down risk is there in futures. In bull call spread, since there is no stop loss, it's not a stop loss. It is the maximum loss you can incur at the expiry. So that means if you are go long on Nifty, okay, you went long in Nifty, since there is no stop loss, even Nifty comes down, if Nifty crashes and again Nifty goes back by month end, by expiry, again you will be in profit. Again you will be in profit. Unlike buying call or futures, if you kept your stop loss gone, right? Even though you kept your stop loss here, your stop loss gone. Even though after market starts going up, you don't make any profit because your stop loss already hit and your trade is closed. But in bull call spread, since there is no stop loss, even though market crashes and again starts going up, you make profit. So you don't have to worry about your stop loss. Just you know your risk. Maximum risk is whatever the premium paid. So you know that this is your maximum risk. This is your maximum loss. Bull call spread is better during volatile market like this. Now currently market is very volatile, right? So even though you keep your stop loss here, it can come and take your stop loss. But bull call spread, even though market is volatile, you don't have to worry. So by the expiry, if market starts going up, you are back in profit. Buying a call option, less probability of profit, difficult to break even, risk of frequent stop loss, vega and theta risk, which I discussed in the beginning, volatility and time decay, and high premium. You have to pay high premium. In selling put option, high margin required. You have seen that for just one lot, you need more than 1 lakh. Risk of frequent stop loss. Even though you keep your stop loss can hit and you are out. But if you don't keep stop loss, then there will be unlimited risk, limited profit. Maximum you get is the premium. But in bull call spread, the advantage is margin is low. You have seen that margin is lesser than selling put, limited risk. You know that maximum you lose is the premium you paid. Easier to break even since your cost will come down. Easier to break even. No vega and theta risk here because you are buying and selling both at the same time. Your vega and theta get neutralized because you are buying and selling both at the same time. No gap down, gap up risk because you know that maximum how much you can lose. There's no unlimited risk. No worry about frequent stop loss. You can eliminate all this risk in bull call spread. But only thing is that you should remember in bull call spread, profit is limited. So unlike naked calls, here profit is not unlimited, profit is limited. And you are a new trader, your focus should be on limiting your risk so that you can get it in bull call spread. Your risk is limited. At least you will not be blowing up your account in a single trade, hopefully. So that is why my suggestion for a new trader, bull call spread rather than going for direct buying call or futures or selling. And that is what I discuss in my upcoming options course, option strategies made easy. Total 14 strategies are there. So this is one of the strategies called bull call spread, which I discuss in detail in my option trading course. So I would say for a new trader, rather than going for naked calls or naked puts, bull call spread is the better bet because even though profit is limited, losses also limited. At least you will not blow up your account in one trade, unlike when you are taking the trade in long calls or long puts. So that's about today's video on no stop loss trading strategy. If you find this strategy very interesting, then you can think about buying my new options course, that is Option Strategies Made Easy. Why I named this course as Option Strategies Made Easy? Because one of the main problem why many people don't bother about learning options, because options is a vast subject and they find it very difficult in learning options. So that is why I try to make this course is very simple that anybody can understand. That's why I named this course as a Option Strategies Made Easy. It is for both option buyers and option sellers. So if you want to gain knowledge on your options, then you can consider buying my new course Option Strategies Made Easy. And as usual, my day trading webinar, especially for people who are hardcore day traders, which I continue conducting regularly. And you can check the details about my upcoming webinar on day trading below this video in the description section, and you can contact me if you are interested. And if you are into full-time job and you can't do day trading, if you are looking for a swing trading course, that also you can find the details below this video in the description section. So that's about today's video on no stop loss trading strategy. Thank you guys for watching this video, and I'll come back soon with a new video. Until then, thanks and take care.